Thank you everyone for joining us. This is the first time that something like this has happened. So I'm going to turn this over to the NAIFA Memphis president, Cindy Williams, to kind of kick things off for us. Cindy?
Thank you so much, Artem. I'd like to welcome everybody to NAIFA Memphis West Tennessee's first webinar during the COVID. Today, our members are joining us from Louisiana, Arkansas, South Carolina, and the rest of Tennessee. I'd like to thank my board members for their input in making this webinar happen, and a special shout out to Mark Miller for lining up our speakers. Just a few housekeeping notes. Please hold all your questions till the end. You may send them by typing them in the question and answer section of your screen. The seminar is going to be recorded so that you can pass it on to a colleague, and you may get the recording from the NAIFA Memphis West Tennessee.org website. Our moderator today is Artem, and we thank you, Artem, for setting this up. And in order of appearance, we're going to hear from Diane Broyles, who is the NAIFA Senior Vice President of Government Relations, and she is going to speak today on the CARES Act. We're going to hear from Mark Massey, who is a VP of SMA Services located in New Orleans, Louisiana, and he's going to speak to us today on the provisions of the retirement plans as they are from the CARES Act. And then we have Ike Trotter joining us from Greenville, Mississippi. He is the past NAIFA Governance Committee member, as well as working as a financial advisor in Greenville. We also have our esteemed former past president from NAIFA, Paul Daugherty. He is a State Farm PNC agent, and he hails from Hyattsville, Maryland. And last on the program is David Guttery, who is from Trussville, Alabama, and he works at Keystone Financial Group as a financial advisor, and he's going to talk to us today about working with our clients during this market volatility. Thank you so much.
All right, Diane?
Great. Thank you so much for having me. It's always fun to be around the NAIFA Tennessee folks in Memphis, and I'm glad others were able to join us as well. Collaboration is always good. I found my NAIFA Tennessee mug the other day. I should have brought that out. Anyway, working from home presents all kind of fun surprises. But let's talk about the CARES Act. So NAIFA was very much involved in working with Congress. The CARES Act is actually phase 3, believe it or not. And we're only, gosh, it's less than a month old that the CARES Act was signed into law. It was signed on March 27th. So we're not even a month in on the CARES Act. And the first phase of the coronavirus relief legislation was earlier in March. So this has moved very, very quickly. Some of the details of the CARES Act, you're looking at $2.2 trillion basically to rescue the economy is what the CARES Act was put together for. It includes tax rebate checks, so it's $1,200 to individuals, $2,400 to married couples. It expands unemployment insurance. You see FSAs and HSAs, HRAs, there were enhancements to those programs. There were enhancements, charitable giving incentives, retirement saving provisions were included. And Mark, I know you're going to go through details on those as exactly what those are and how to take advantage of some of them, some of the questions that you're getting. Perhaps the biggest is the Paycheck Protection Program for small businesses, and that includes self-employed individuals as well. That program ran out of initial funding last week. So essentially, if your loans are in process, they're paused. Good news is you're in the queue. So when funding is reauthorized, you're still up next. So you haven't wasted your time by putting in that application. If you hadn't heard back yet, you're still in that queue. If you hadn't applied, you can't until they reauthorize the program. The good news is we expect the Senate back in this evening. They come in at 4. I expect that they're going to vote on it. There is a deal. Here, they're $350 billion more for the PPP program. So that's that Paycheck Protection Program and the loans that go there. There's $50 billion for the EIDL, so if it's the economic injury disaster loans that you're looking for, there's additional funding coming for those as well. $750 billion for hospitals and an additional $25 billion for expanded testing. That's the negotiated deal. Still haven't seen the language, but those are the details that we've gotten from the Hill as to what's going to be included in what we're calling not quite phase 4 of the economic recovery, but really more of a CARES Act 2, because it's taking the provisions that were in the CARE Act and really reauthorizing funding for those. I don't anticipate that there are going to be changes to the program. So the way that the program operated when it was initially funded is the way that it's going to operate when there's additional funding that is passed. As I said, Senate's in tonight. We expect them to vote. House members are making their way back to DC and are anticipated to vote on Wednesday. So by the end of this week, we'll have that program refunded, reauthorized, get your documents together. NAIFA National actually has a webinar on that program on Wednesday, and we'll probably have additional information as far as what exactly you need to have in place when you go to apply for these loans if you're interested in obtaining one of those, either for yourselves as small business owners or to advise your clients who obviously are very interested in these programs too if they didn't make that first wave. CARES Act also includes employment retention tax credit. So some of the folks that may not be eligible for the Paycheck Protection Program may be interested in that employee retention tax credit. It has a delay of payroll tax payments for the employer, so you can take advantage of that. There's a carryback of net operating losses that's included in the CARES Act. There's employer-provided tax-free student loan repayments if employers are looking for additional ways to support some of their employees that have student debt. And all of this, as I said, was signed less than a month ago. We're already working on phase 4, which I said what passes tomorrow and later this week is really that CARES 2.0, not necessarily phase 4. Phase 4, the provisions that we've seen so far, the first 3 phases, are really an immediate relief. So we have this medical crisis and Congress is saying, how do we address it so that we can really take care of the health component of it? And then there's the economy, and how do you get that economy? How do you get that cash flow back into the economy? Because when you see businesses shut down or employees who actually leave, it's hard to get those businesses reestablished. It's hard to bring those employees back. So what is the cash flow that's needed in order to keep businesses running and keep employees employed so that we can move over and sort of get into this economic recovery? That's what the next phases are. That's what you started to see in phase 3. It's what you're going to see in phase 4 and potentially a phase 5. There were provisions that we were trying to negotiate to get into even the 2.0 that haven't been addressed. So there definitely is going to be a phase 4. And once you get through that, you're going to have to see how the economy is adjusting, how the virus is being controlled and contained, and then what are the next steps that are needed. NAIFA is working on a number of provisions that we're hoping to have in that phase 4. Some of it is because our members run the gamut. We have some of you that are involved in the health space. We have some of you that are in retirement planning and pure life insurance or risk protection products. So we have 3, what I'm calling them areas of opportunity for us. We're looking at on the healthcare coverage, can we get employer subsidies for those that are continuing to provide their employees with healthcare benefits? We would look at expanding some of the COBRA subsidies, expanded HSA use. Do we need a special enrollment for the marketplaces? And is there increased subsidies perhaps for those in the marketplaces? In the retirement space, actually before I get to the retirement next steps, there's also a couple of industry tax provisions that we're looking at, and it really is kind of a complicated formula. There's an index for outdated rates in the IRC code section 7702. And then it would also reclassify bond investment holdings as ordinary instead of capital. because they support ordinary liabilities of their insurance companies. So there's sort of technical tax elements there. And then in the retirement space, we're looking to further increase the RMD age to 75, which I think would be helpful. Allow greater use of lifetime income products. So we're working on that. Allow catch-up retirement contributions for those that would be afflicted with the COVID-19. Expand retirement saving options for some of the nonprofit employees. And then to clarify that startup tax credits that were part of Secure that would incent small businesses to join multiple employer programs and to take advantage of some of those opportunities to really help Americans keep their money longer and help them save more for retirement. Because in this time of crisis, the retirement savings that they had planned might not last quite as long as they had originally anticipated. So we want to make sure that we're still allowing people to save for their future and plan for their retirement. So I don't want to overstay my time. I'm going to kick it over to Mark, let him do a deeper dive into the retirement saving provisions, which are really what NAIFA worked on probably the most diligently when it comes to that CARES package. So Mark, I'll hand it over to you to do the deeper dive and know that more is coming from us in phase 4 and 5. And God, I hope that's it. We'll be done by then.
Thanks, Diane. Again, my name is Mark Massey, and I am with the Southern Medical Association Services. We're out of Birmingham, Alabama. However, I live in the New Orleans area. And originally from Memphis, so I lived in Memphis, was born there, raised there, lived there for over 50 years actually, so always got a place in my heart for Memphis. So what I want to do with my time, as opposed to reading a lot of laws and legislation, is go through the questions that we're getting as a TPA from our plan sponsors and our advisors, because there's a constant theme. But before I get into that, the CARE Act really breaks down to 3 areas: distributions, loans, and RMDs. But before I get into the questions that involve those, I want to take the question that we're getting the most from plan sponsors. And that is, how do I stop the match? Because the first thing, or one of the first things employers think of when they get in dire straits financially is, eliminating the match. So there's all, and I'm going to keep everything focused on 401k plans for time purposes, because the majority of plans that we sell and service are 401ks. And I mean all of us. So let's take the easy one first. If they have a traditional 401k and they want to stop their match, it's easy. They just, if they have a stated match in their plan, which they shouldn't have, but let's assume they do, then they could just call their third-party administrator, their record keeper, if it's a bundle plan, and say, I need to amend the plan to cease the match. If it's like the majority of plans that are written discretionary, that doesn't even require a plan amendment. So they do a board resolution, boom, we're out of the match, go forward. But I want to focus on safe harbor plans, because this is where it gets a little trickier, and this is a chance for you to bring value to your clients with knowledge and expertise. So when you have a safe harbor match, and I'm just going to take this through a conversation that I've had with multiple employers who have called me, and I refer to it as talking them off the ledge. So I'm going to kind of role play it with myself. So the conversation always begins, I got to stop the match. I'm like, okay, let's talk it out. So there's 2 roads you can take in this area. The first road is, if you stop the match like they initially think they want to do, then we can amend the plan. The way it works is you have to give a 30-day notification. So today is what, the 28th? Or no, 21st. It's what happens in New Orleans when you lose track of time. Then you could say, well, we're going to stop the safe harbor match on 5/21, and you have to fund it through 5/21. So it requires a 30-day notification, and then you have to fund it through the 30 days. But when you do that, you are now subject to discrimination testing for this year. And that, they wouldn't have bought a safe harbor plan to begin with unless they anticipated having discrimination testing issues. And then what happens when you stop the match, people start dropping, coming in. The non-highly compensated is often cease their deferrals, which is going to further complicate the matter and increase refunds. So here's what I say to people. Let me show you, like to teach you at the beginning, let me show you a way that might fit your needs better. So what you do is say, look, if we amend your plan to where the match has to be contributed on an annual basis, because most plan documents are written to where, you know, they match per payroll. So I amend the plan. I personally have been waiving fees for amendments during this period because it's the right thing to do. But let's amend the plan to make the safe harbor match on an annual basis. By doing that, that gives us till, assuming the plan's on calendar, keep it simple, that gives us till December 31st of 2021 to make that matching contribution. Well, by then everybody thinks it'll be over, and assuming they're, you know, profitable before the virus, they assume that, you know, it'll be profitable after the virus. My music just kicked in. But so they'll say, you know what, I think it'll be okay then. So what I've done is I've delayed their payment of that match till a later date, and knowing they'll probably make it before 12/31 of 21, because, you know, this is eventually going to end, then they're not subject to the discrimination testing for that year. So just a tip, tell you, be a trusted advisor for them and help them. And hey, I'm telling you, I'm batting over 900 on this, and the only ones that have not done it are people, we have a lot of oil companies down here, so you know, tough with them. Okay, moving on. So the next biggest question that I'm getting is on distributions. So the first thing that has to happen is they have to, being the plan sponsor, they have to decide whether if they want to adopt the amendments for the coronavirus, because you don't have to. The employer could just keep the plan as is, nothing changes. So we're going to make the assumption they want to add it. Now, why would they add it? All these rules around these Coronis distributions and loans are to get money in individuals' hands. That's what they're for. So some employers may want to, you know, take the tyrant position and not allow it. But assuming they do, they have to amend their plan. So then they have to see, they got two roads again. Do I want to do it just for distributions, or three roads? Just for distributions, just for loans, or both? Okay, so let's just assume they do both for the purpose of this education. So here's what changes on the distribution rules. So now we'll consult my notes here. So first off, we waive the 20% tax withholding. Normally when one of our participant calls from a distribution, we send them their check, we have to withhold 20% for taxes. So if they request 10 grand, they're getting 10 grand. We're not withholding. They could take up to $100,000 out of the plan, and there's no penalty for early withdrawal, and I already said there's no taxes. Now they have, so let's play this out. Let's say that I take 50 grand out of my 401k. I now have 3 years to where if it turns out I don't need the money, I can either roll it into an IRA, what's left, let's just play it out. Let's say I spend 20K, so I got 30 left, but I didn't need that 30. So I can either roll it into the IRA or, you know, back into the plan. Then I have up to 3 years to pay the tax on the $20,000. So I can stretch those that tax liability over the next 3 years. Okay? The next option would be to take a loan. Well, under current rules, it used to, well, it still is, that you can borrow either 50% of your vested account balance up to $100,000. Well, if you adopt, being the plan sponsor, adopts the Coronis provision amendment, then that takes that 50% cap to 100%, takes the $50,000 cap to $100,000. So now I have an option. Do I want to take a loan from my 401k, or do I want to take a distribution? So again, options are good. Let's say I have an outstanding loan now, because many people do, and let's just say I owe 10 grand on a loan. I have the option, if the plan sponsor takes this amendment, to stop my loan payments through the end of the year. A lot of confusion in that area. A lot of people think it's 12 months. It is not. If I suspend my loan repayment schedule I can only suspend it to 12/31. In addition to that, if I start a new loan, I could defer those payments to January as far as my repayment schedule. Okay, so that takes care of the loan part of it. The RMDs, I don't want to spend a lot of time on that. I'll be glad to answer any questions offline, but I'm trying to be cognizant of our other speakers' time. Essentially, nobody's taking RMDs this year unless they want to. That's the bottom line. Or if they were supposed to take their first one, they can defer it too. Real clean on that. And then just some really quick, some other questions I'm getting. Here's the real common one. So I used to work at the Vanilla Ice fan club, but I quit there anymore because it was a dwindling group of people. So now I work someplace else. The question is, can I get a distribution from my terminated employer's plan? And the answer is yes. Okay, so you don't have to be an active employee to take a Cronus-related distribution. You could be a former employee that still has a balance in that plan because you left it there because it was doing well. Can a participant take multiple distributions as long as they keep that total under 100K? The answer is yes. I take out 20 grand, it wasn't enough. I come back later, I could take an additional, well, I took 20, I can take up to 80 more in increments if I wanted to. Here's a common one too. If my spouse is laid off, would that qualify me to take a COVID-19 distribution from my plan? The answer on that one was no. That was a little surprising because they're so liberal with everything else. Not on that one. Can a plan sponsor set a lower limit for their distributions and loans than 100 grand? In other words, you know, I want to give them a little latitude, but I really don't want to go all the way up to 100. And the answer is yes. So they could, for example, set the limits at $75,000. And Roth, that's another one. How about Roth withdrawals? The Act did not discuss Roth. So Roth is not in play. So those are the most common questions that we're getting. I tried to cover as much as I can in a lot of time. If you have any other questions, you could chat them up and we'll answer them at the end. Thanks.
Hello, I'm Ike Trotter from Greenville, Mississippi. Greenville is actually just a couple of hours down the road from Memphis, and I've been a NAIFA member now for some 45 years. I had pretty well prepared my comments today as a repeat of what I had talked about a few weeks back on one of NAIFA's town hall webinars that we conducted a couple of weeks back. My comments were about the new communications tool of Zoom technology and how we have applied its uses to staying in communication with the business of NAIFA. However, what I described just a few weeks back is already outdated and obsolete to a great degree. You see, our world of communicating is truly changing very rapidly. Frankly, there's no better example than what I read in my last weekend's Wall Street Journal section entitled "The Year of Living Digitally." Zoom technology is with us. Our Jim's Cafe Coffee Club, to which I'm a charter member, we're conducting our conversations now weekly through Zoom. So it's all around us. Anyone in NAIFA who's had the opportunity to meet our Vice President of Marketing, Suzanne Carawan, has seen the talent that Suzanne has for both promoting NAIFA as well as communicating our presence in the financial services industry through its social media outlet. Our new NAIFA website is a great example of her work in making our NAIFA message today relevant and eye-catching. And through working on some committees with Suzanne, we've become friends. And Suzanne, quite frankly, was quite impressed with how a guy who operates admittedly a small practice in small town America, that's Greenville, Mississippi, a town of some 35 people, could stay in communication with the technology of Zoom through our conference calls. Well, my message to you today is Zoom technology is a game changer. And make no mistake about it, it can change how you operate, particularly in conducting your NAIFA activity. I encourage each of you to look into this means of communications to conduct your NAIFA business. With the work of NAIFA National, we're doing our committee work via Zoom, and it's replaced travel and also a very effective and efficient and cost savings means of communication and conducting the work that needs to be done. So that's just a little snippet of Zoom technology. Most everyone now is familiar with it, but it's working with us, with our committee work with NAIFA, and I wanted to pass that message on along. If there are any questions later on, I'd be glad to answer them if I can, but at this time, we'll now pass it on to our next speaker.
Ike, it's great to follow you and great to be with all of you. This is Paul Doherty. I'm speaking to you from my State Farm agency just outside Washington, D.C. in suburban Maryland. And I want to spend just a few minutes with you today talking about running your P&C operation in this challenging COVID-19 environment. Ike talked about using Zoom technology for his coffee clubs outside Washington, D.C., and Diane can attest to this. We're using Zoom technology for happy hours. So hopefully all of you can capitalize on that as well. We in our agency are used to having between 20 and 30 people walk into our office every day for appointments or for walk-in. And in this environment, we're seriously challenged by these stay-at-home orders. But as an essential business, we continue to serve our customers both here in the office each and every day as well as remotely. So we want to spend just a few minutes this morning talking about how to position your agency so that you can do so. In our area, we serve mostly a diverse population. Over 80% of my new customers are Hispanic, and the vast majority of this community is African American and Hispanic. And so I mentioned that only in the context of the different segments of your customer book will communicate with you in very different ways. So how to position yourself. Listen, obviously none of us have been in this position before. We have not faced a global pandemic like this, with the exception of very few folks that are well senior to us. But you have to figure out how you can then position and control your own agency and environment and how you're going to respond to that. The first thing I would absolutely suggest doing is very basic, and you know this already, but set your goals. Set your honest goals in terms of how you are planning on reaching out to your customers, how many Zoom meetings you will have each and every day or during the course of the week. And obviously the timing changes. You're not operating on a normal 9 to 5 office hour basis. Sometimes we're getting together with folks literally in the evenings, could be on a Saturday morning. Obviously it's very flexible now in terms of how we connect with our folks. But I would see this as a great way to grow your relationships with your current policyholders, as well as create relationships with your new policyholders. So we want folks to understand that you're here and that you're a resource. The reality is that many people are nervous about what's going on around them. They're anxious about the future. They're anxious about money, about their health. But they're also home and they're captive. And you can find them because they are accessible to you via technology. And now the idea of, hey, I don't have time to come into your office to do this appointment, that excuse is now kind of out the window. So I'd certainly suggest that while you're ensuring that you are putting your best face forward, look at your online presence. Many of you have your own websites, or you may be part of your company website. How do you appear to your customers online? Are you updating your content? Do you have a company or agency Facebook page? Are you posting relevant information on there? I would definitely suggest that the way folks are communicating these days is more video centric. So if you have a capacity to put a video snippet on your Facebook page or on your home agency website, I would certainly recommend doing that. If you need to refresh those things, be sure that you're putting updated information in there and good relevant links for folks to follow. In our agency, as a State Farm agent, we are Obviously, in the forefront of that PNC piece, and what a lot of our calls are to the agency right now are questions about refunds or relief to their premium payments as a result of the loss of work for many people, the work from home, and in general, this pandemic scenario. So you have to give your clients confidence that you're looking out for them and have those resources at your fingertips so that you can share them with them. Not just about how it applies to them directly, but some of those other issues that may be coming up, how they communicate with the MVA when the MVA offices are closed, how to get information from the Small Business Administration. Many of your customers may have small businesses themselves and may have questions about the PPP, and you can be their trusted resource to help push them in the right direction in the event that they don't have wonderful folks like Diane looking out for us. And to that point, it's my understanding that the last town hall that Scott Cinder had done on the PPP that is to be built upon tomorrow during the NAIFA town hall, we had over 2,000 people on that town hall meeting. And you'll note from the NAIFA website, it's open to members and non-members. So I would tell you within the next 24 hours, if that's a good thing for you to communicate with your small business owners, I would push out that invitation to show them, hey, this is an organization I'm a part of, and they've got great information that they can deliver right to you on your desktop. The thing that I would remind you more than once during my few minutes with you is that you're planting seeds for opportunities. You may not be able to sell that policy to that customer this week, but you are planting those seeds so that you can come back to them over the summer or in the fall. They'll have more confidence in you because they know that you're looking out for them. I would definitely be making sure that each and every day you're starting with a plan to do your check-in calls. Those check-in calls can go a long way. Again, to building relationships with your current customers, to making sure that they're okay. We've done calls where literally it's they're very senior, an 85-year-old grandmother who's by herself. We just called to wish her a happy birthday last week. It's no more than that, but their kids know about that, and their grandkids who do business with us know about that. And so you're reinforcing the value of that relationship that you have with that person. But you can also very strategically make sure that you're running your premium list and see who those big clients are that you should be reaching out to, just to ensure that they're okay. They may be working from home. They may be working from another home that you don't even know that they have, which again may create an opportunity for you to talk about rental properties or other locations. I think we're going to find at the end of this that many people are realizing that they can work remotely. And so what's that going to mean to them in their future employment situation, whether they become self-employed by choice or self-employed by result of circumstance. They may be looking for you to provide them some information on how to be that small business owner. But you may also be creating opportunities down the road so that as their business develops, you're their trusted advisor for all of those business lines as well. So, you know, we've had some fun with folks when we get a call in, they may be reaching out to ask us some information, and we'll pivot with them. We'll use that opportunity to say, hey, Mr. Jones, I understand you've been in a home for a month. You've probably been going through the closets and the basement and the attic, just like we have. You may have found some things that we need to address. And honestly, we have a lot of clients who have collectibles. They have coin collections, stamp collections. They may have firearms that they want to insure. And now's the time where we can go through that sometimes painstaking process, but they have the time to be able to say, hey, let's put a policy in place in order to be able to protect them. And this is a kind of a fun way to try to take advantage of the fact that they are home. Other folks are actually spending some serious money on building out home offices. So this, as your PNC agent to your clients, you may need to talk to them about, hey, how are we modifying the coverages that you currently have? Or are there other people in your group? This is your way to pivot to referrals. Are there other people that you're communicating with that perhaps I can reach out to? You've shared a video of mine with them to be able to say, hey, here's some resources for you. This would be a good way for you to be able to ask them for referrals in a very simple, soft, non-challenging way to be able to say, hey, push out my email or push out my video. This is also a great time to be reaching out to your centers of influence. Who are those folks that you're working with in the community, the realtors, the apartment complexes nearby? Let them know that you're still present, that you're here and you're accessible, and that you can give them and their clients a great experience. As Ike talked about, obviously using Zoom technology or Skype or Google Duo to meet up with your clients is a great way to do that. Obviously, you need to check with your compliance folks if you've got some specific company issues that you need to address. Also, I want to say that many of us are doing our very best to be able to support those doctors, nurses, and first responders in our community that are really doing heroes work. And it's okay for you to represent the fact that you're an agency, you're a small business in their community. And, you know, if you're providing them some branded merchandise, don't be ashamed of that. That's part of the relationship that you have in asking them to recognize your appreciation for all of the work that they're doing. And finally, if you're running your multi-line agency, perhaps you're doing other things beyond just the P&C market, you may be looking at this as a great opportunity to talk about some of those other lines of business, whether you're pivoting into the health insurance because their employment situation is challenging. You may be talking to them about life insurance. In our agency, we have folks that don't even need to come into the office, and some of those life insurance products that they're looking for are appropriate for electronic signatures, and we're able to put those in place for them, as well as some of our speakers have talked about today, retirement benefits. If they are soon working on their own, or they're going to be managing a small business on their own for the first time, let's talk to them about what retirement benefits we may have. Again, what I mentioned is continue to try to be a positive resource for your clients and your prospects. And it's likely to be one of those situations where you're not just creating current sales opportunities, but you're creating a pipeline for future sales. I wish all of you good luck and good health. And now I'll kick it over to Dave Guttery for our final hit of the day. Dave?
Thank you, Paul. Before I begin with my comments, I would just like to echo everything that we just heard from both Ike and Paul. 2 months ago, as this cathartic leg down really began to unfold, we circled the wagons here and identified all of the many ways that we could lead from the front. In fact, that's become our catch slogan, if you will. How can we be front, center, and visible in a meaningful and impactful way and lead our clients through this period of time? Adopting Zoom and Intercall, our social media, our website, our constant contact. We've identified a multifaceted approach to just staying in touch. We don't have the solutions to all of the problems. There's not a magic bag of ticker symbols that we have to put a Band-Aid on things and make it go away, but we are reminding people of why we did what we did, the strategy that went behind the objective that we identified through financial profiles with the information that they gave us. We're taking a look at where we are relative to that goal. We're talking about the things that we can do to adjust for variance. And I would just like to echo the fact that you're proactive and you're visible and you're there, and affirming to those clients that you're on top of this goes a long way. I think that the fastest way to foster panic is to be invisible. So we've certainly embraced areas of technology that we never dreamed of embracing, but for this period of time. Mark Miller had asked me to participate in today's meeting to talk more about the insurance-related products that we bring to bear as part of holistic financial planning. And Mark and I have known each other for years, so he knew what he was getting into when he asked me to do this. Sorry, Mark. Before I really dive into those comments, let me describe our practice. I'm the president of Keystone Financial Group here in Birmingham. We actually have 2 campuses. And at 30,000 feet, every single thing that we do is objectively driven, meaning we've never haphazardly thrown money at the market or adopted a tool or a strategy just for the sake of doing it. We have a 2-page defined process that covers the acquaintance to the onboarding, the integration, the assimilation, the presentation of the workshop material, and then there may be 2 or 3 of these workshops before we get to our final version, before we even get to implementation. And that might take 3 or 4 weeks to get to that end. But by the time we're there, clients know exactly where they wanted to go, how to get there with the path of least resistance, and which strategies made the most sense for accomplishing those objectives. So I'm telling you all that to suggest that we had proactively planned for periods of time like this years ago. There is no such thing as reacting to a period of time like this. So I would encourage you to look at your own practices that way if you do financial planning, and to look at it as a proactive approach rather than reactive. I've used this analogy before, and I think it's effective. Think of me as a general contractor, and you're coming to me because you're remodeling a bathroom. All right. Well, I don't know that maybe you would. I wouldn't hire a general contractor that only had one tool. There is no such thing as a bathroom remodeling project that doesn't involve several tools. So the first thing that I need to know is, tell me about this project. What are we doing? Are you driving a nail? Are you tightening a bolt? Are you turning a screw? Are we cutting a block of wood? Because I have every tool in the box. I need to know which one that you need. All right. It's not about me trying to sell you a hammer. It's about me bringing the right tool to the table. And we've all seen the commercials. There is a person that we all know and love that touts such publications as Annuity Bunk and so forth and so on. I would love to have 10 uninterrupted minutes on national business media with him one day. Yes, hammers may be more expensive than screwdrivers. That's not going to help you, though. The screwdriver, in spite of it being lesser in cost, isn't going to help you if you're trying to drive a 10-penny nail. So it's all about the utility of the tool and using the right tool in the project. Products or tools. You know, again, it may sound overly simplistic, but when you convey this to a client in this way, they get it. They understand. If I need to miter a 45-degree edge into the end of a 2x4, I'm not going to offer you my socket wrench. You know, there's a miter saw for that. So when I say that we approach it from a utility standpoint and a holistic standpoint, the majority of what we do is managed money in advisor-driven managed money accounts, but we bring in other tools too to accomplish various and sundry needs, but to complement each other. Nothing is ever done in a vacuum. One thing gives rise to the other, or supports the other, or complements the other. So, for example, in a normal traditional period of time within a managed account, you might construct a traditional fixed income ladder. And that might be 10 to 15 or even 20% of a growth goal-oriented type account. Well, right now is probably not the best time in the world to take a traditional approach. So we've looked at non-traditional ways to accomplish the same thing. We've done this in a number of ways. When you're looking at holistic financial planning, it starts with the risk management, especially if you're someone my age. I've still got many years of accumulation and deferral left in my future. Well, my retirement objective is a function of the assumption that I'm going to be here and earning an income. So disability is one thing that we hammer home. We've got to ensure the ability for your payment of debt service and mortgages and putting food on the table so that you don't have to invade that which we are planning on you not touching for another 15 or 20 years. We also look at things like life insurance. Clearly, we need to make sure that debt indemnification is addressed, salary. If a household is dependent on 2 salaries, there are young children, where's the college fund going to come from? We've got to make sure that the life insurance is in place. And I doubt that you'll find many people my age. I'm 51. I have aging parents for whom one or both may have long-term care in their future. I doubt you're going to find many people in our generation who aren't already taking care of parents to some degree, or that haven't experienced the expense of long-term care with their own parents. So I am actively talking to clients about how they have prepared for this themselves, and a shockingly low percentage of them actually have. So how do we bring all of this together in holistic planning? Well, we may roll over an inactive 401k, establish an IRA. This client has, maybe it's $750,000, and we have an at-risk portfolio and a statement of investment selection where we've identified him as or her as an investor. But we don't want to put everything at risk. We want something there that's negatively correlated. Well, typically we would build that income sleeve. Well, not today, for reasons that we'll get into on another hour-long call. What we've been doing is looking at deferred, tax sheltered on the non-qualified side, principally guaranteed, external quasi-bond sources of risk offset. So what would that look like? Maybe an equity indexed annuity. If that client doesn't have any additional need for the construction of durable income, there are plenty of good equity indexed annuities out there that have no bells and whistles. They're just a straightforward equity indexed annuity growth contract, but it protects principal on a non-qualified basis. It's a tax shelter, and it becomes a zero beta environment that functions as a quasi-bond risk offset to what we're doing in the managed account. So just to give you a really simple example, if I have a client that wishes to maintain a beta profile of 0.5, and we split the accounts in two, in the managed account, maybe that gives us the latitude to assume a beta profile of 0.85 to even perfectly correlated of 1, while we're putting the other 50% in an environment where there is no risk. Holistically, that client's beta is now at 0.5. What if there is a need, though, to cover life insurance or to cover long-term care as a surrogate to traditional long-term care? Indexed universal life policies are, in my opinion, a very fantastic tool to, again, guarantee a principally guaranteed source that acts as that external quasi-bond offset to the risk that you're taking elsewhere, but also in such a way where through a rider, we can give rise to a long-term care benefit where half the death benefit is payable over a 5-year period of time. There are true hybrid chassis out there. Pac Life has a great one that I've come across here recently that are more driven by the long-term care aspects and not so much the life insurance aspects. But there are plenty of tools that are designed for that aspect. Clearly, we're covering the need for life insurance. And so when we approach it holistically like that, a policy like this does several things. We've mentioned that it becomes the external negatively correlated risk offset to a managed account. It also becomes the source of life insurance as well as the source of long-term care. It becomes an extension of that person's safe money and what they're doing in cash accounts anyway. And in certain states, state of Alabama, for example, it can also shelter assets against litigation. So there are 5 things that this one policy has done that we are bringing to bear and using as a risk offset to everything else that we're doing on the investment side. And now we look at everything holistically. It's not one thing in a vacuum. On the 23rd of March, on average, while the market was down 38% from its February 12th high, I was having review meetings through Zoom and through other remote means where performances were down 25 to 28% while the market was down 38%. And that's great. We outperformed the market, but we're still down 25 to 28%. For those clients that had used a principally guaranteed product, though, their holistic return was down more like -13, while the market was down -38. I can assure you that those were some very good conversations that we were having with clients at that time. And as an awareness, it has drawn these insurance products that we have brought into the investment discussion into greater focus. We're beginning to get calls now throughout March and so far into April of clients wondering how they can contribute more to these products, which brings into play another problem. Usually, if we're using permanent insurance, we are funding that thing to its TAMRA limit. Otherwise, why do it? We want to be able to maximize the performance of the cash value. So rarely do we sell an underfunded permanent policy. So we're already funding these things on the life side at the maximum levels possible. All right, well, now we have clients calling and asking how we can put even more money in it. Well, we'll have to re-underwrite another policy. So it causes the client to look at the utility of the product and beyond just being a life insurance policy, but also a solution to bring about other objectives too as a part of a holistic plan. Just and as a point of reference, last week, a client for whom we had used an equity indexed annuity called and asked if we could establish a $7,000 per month bank draft to redirect funds from where they were going into an at-risk account into this one, simply because he's tired of taking risk. And that was what he wanted to do. So it's bringing this period of time through which we're going is bringing our insurance products into greater focus in terms of what they do. It's not just life insurance. It's not just an annuity. This thing can be used in a myriad of ways. So I would encourage you to look at the financial planning work that you're doing in that regard as holistic, and the multiple things that one tool can do to serve many different needs. We've covered a lot of the things. I'm kind of looking at my list of bullet points here. And the bottom line is, at the end of the day, what has this caused us to do? Yes, it's caused us to embrace technology that we hadn't done before so that we don't miss a beat and we continue to move forward. We are aggressively reaching out to clients through as many channels as we can. That puts an added layer of cement over those relationships. They've invested their trust in us, and this is the way that we are honoring that commitment by doing everything that we need to do to stay in touch with them. We're reminding them that this is not a time to react. It's a time to go back and revisit the tenets of a proactive plan and go back and revisit again the utility of all of the tools that we brought to bear. And what we're finding is a much greater awareness and appreciation and understanding of the insurance parts that we brought in to complement what we were doing at the at-risk accounts on the managed account level. And it's really been successful. So this is a time for you to do exactly that with your clients too. I would suggest engaging them in conversation, just to remind them where we are. A lot of them you may find would be encouraged or at this point would be interested in talking about how you can expand that within the holistic approach that you've taken. So Mark, I think that's what you wanted me to talk about today. So I will turn that back over to you, Cindy, or whoever the moderator is.
Thanks, David. Appreciate that. So we will open up the board for questions for anyone that does have any questions. Feel free to type it in the question and answer box or in the chat. If you do have a question you would like to ask for it live, feel free to just simply raise your hand within the platform and I can allow you to talk through the unmuting process. So if you have any questions, please let us know who the question is for, and then we can go from there. The only question I saw before this that came through was about the recording. Once again, reminding everybody this presentation is being recorded and will be posted on the NAIFA Memphis website. We will try to get that up within 48 hours, hopefully sooner than that. So do we have any questions for any of the panelists? Oh, there's one that came in. Yes, the entire meeting will be available. Do we have any other questions? We have one question coming in from Cami Scott. What is your top tip for staying motivated during this time? Does anyone care to weigh in? Anyone at all?
I'll take that. And I think we all probably have a similar answer. My millennial son just graduated from the University of Alabama and has joined me here at the firm. He is now an IAR and appointed with our parent company and is drinking from a fire hose. So I'm trying to keep it meaningful and impactful, but high level for him too, as we work through this first 3 years of his career. But the one thing that I told him that he has seen me do in practice, and I mentioned this in my previous comments, what motivates me every day is knowing that I've got over 1,000 clients out there that are depending on me to be on the other end of this phone. And not just to react to their phone call, but to proactively bring to them what they need to know. And here's my standard. This is the crossbar that I'm trying to get over every day. If I were my own client, what would I be expecting from me right now? If I were sitting in that chair across the desk, what would I be expecting from me? That's the level of service that I'm trying to meet as I'm working with clients. So that keeps me motivated. I know that there's a very high standard that I've set for myself, and I know that my clients are expecting no less from me.
What I would add to that, is my mic on?
Yep.
Is when all this started, people were saying the unemployment rate would be 30%. It's 13. They said there would be, the amount of deaths kept dwindling down, but the most common number you heard was 100 when we went to lockdown. Looks like that's going to be under 50. If somebody would have told me before this started that the stock market is where it is today, there's no way I would have believed them. So considering everything, and there are a lot of individuals who are actually in a better place financially than they were before, and that's primarily the group that needs it the most because of the things that the government has done to help subsidize during this period. So I guess my take on it would be, given the way this started, what motivates me is we're in a much, much better position than I thought we would be 6-8 weeks ago.
Anyone else? All right, do we
Well,
have?
I would just say, this is Paul, from my perspective, we're built for risk. It's the business we're in. This is what we do. And sometimes it is someone's having the worst day of their life because they had a car accident or a house fire. We just happen to be handling a lot of people at the same time with the exact same reason. In Washington, D.C., if it snows half an inch, everything shuts down. This is, from a pandemic perspective, such a common, terrible situation for everyone to have to deal with, that you don't have to explain that part of things. You don't have to try to accommodate people's misunderstanding of what's going on. We're all going through the exact same situation. How we address our ability to respond to our customers is really what makes the difference in all of this. If they can remain confident in what we can offer them, then I feel like we have done exactly what we were put here to do.
All right, thanks, Paul. Do we have any other questions for any other panelists? Oh, look at that, right on time. Any closing remarks from anyone else? All right. Once again, thank you everybody for joining us. We will make this presentation available through the NAFEM Memphis website. Please allow us to have about 24 to 48 hours and we will have that up. Once again, thank you guys for taking the time out of your busy days to come in and do these kinds of presentations. I know that all 4 states greatly appreciate it, and we look forward to working with you guys in the future.
Thanks for
having us. Have a good one, everyone. Thank you.